In this video, we're going to look at Skyworks Solutions, and they manufacture semiconductors for radios and mobile systems. And what I do in my videos is I try to figure out the actual stock price of a company by looking at their prior financial information, and then look at their financial ratios and compare them to similar companies in their industry. So let's get started with the model. This company has a market cap of $22 billion, and that's the value of the company according to the stock market. And they're trading at 132.04. And let's pull some financial information. We're going to look for the free cash flows. And free cash flows is how much cash is remaining after a company pays its expenses. So the way to value a company is you estimate the future free cash flows and then discount that number back to today's value. And that's what I'm doing here in the video. Now I'm pulling the net income, which is a profit and loss for the company according to the income statement. And then I'm going to pull the revenue, which are the sales on the income statement. So even though their revenue increased from 2016 to 2018 each year, their net profit margins decreased. Usually when your revenue goes up, you should be more efficient. Net profit margin is net income over revenue. It's how much money a company generates from its revenue. So let's look at the capital structure of the company. They have no debt. So let's get their cost of equity. We need the beta for that. And beta is how much the stock moves relative to the market. And their beta is 1.25, so the stock moves a little more than the market. So it's not too volatile. Let's get some more information from the balance sheet because we need to look at the ratios later. So let's get their current assets. These mainly consist of cash, accounts receivables, and inventory. And that's on the balance sheet, and that's $2.2 billion. Let's get their current liabilities. These are debts and payables that are due within 12 months. And that's $374 million, and the total equity is the assets minus liabilities, and that's the value of the company according to the balance sheet. Next, we're going to pull the EBIT. That's earnings before interest and taxes. They call that operating income on the income statement, and that's $958 million. So the cost of capital is 11.92%, and we figure that out by using a capital asset pricing model. And we're going to use that number to discount the future cash flows. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. We discounted those amounts to today's dollars, and we get a value for the company of $16.3 billion. We divide that by 167 million shares, and we get an intrinsic stock price of $98. They're trading at $132. So they're trading at a 35% premium. So it's a sell according to the model. Let's see what Simply Wall Street values the company at. So they go in a totally different direction. They're valuing the company at $175. So I'm not exactly sure why they're valuing the company so high. I'm just using their prior financial information. Let's see where the stock has been trading the past few years. Looks like the stock has been all over the place. It looks like it was trading around $100 for about a year or so, then dropped to the 70s or 80s. Now it appears to be trading at its all-time high. So the stock price is really based off of supply and demand of the market. It's based off of the sentiment of investors and how they feel the future of the company is going to perform. Let's look at their financial ratios to get more information on this company. So they have a price to earnings ratio of 25.8. That's a pretty high ratio. That's price of stock over earnings per share. That means investors are willing to pay $26 for $1 of earnings. I generally like to see under 15 for this ratio. They also have a high price to sales ratio of 6.5. That's price of stock over sales per share. And the price to book is a little on the higher side as well at 5.3. That's price of stock over book value per share. They have a really high current ratio of 6.0. Usually don't need much higher than 2. Let's look at their balance sheet. So they have $1 billion in cash, $460 million in receivables, $600 million in inventory and 100 million in other assets. Their current liabilities is 374 million. When a company sits on so much current assets and cash, it means they're not as efficient as they could be at running their business. I want a company investing in their business to grow it by 10-20% a year, not to sit on cash which earns less than 1% a year. They have a pretty good ROE at 21%. That's net income over equity. And they don't have any interest coverage ratio or debt. The best way to look at a company's ratios is to compare them to similar companies. And I've done videos on Intel, Micron, Nvidia, and Texas Instruments. And right here is Skyworks. And if Skyworks has a number in green, that means they're better than the average. And if their number is in red, that means it's worse than the average. And if a number is in orange, that means they're the best in that category. So Micron has the best PE of 8.8. Skyworks is 25.8, which is better than the average, but that's still not a good ratio. Skyworks is better than the average in price to sales, but it's still on the higher side. Micron is leading in that category as well as price to book. All companies appear to have a pretty high current ratio except Intel, which is below 1. The average ROE is 29%. Skyworks is lower than the average, and Texas Instruments is the best in that category at 56%. So they're providing their equity holders a great return. Skyworks is the only company that's debt-free, so that's a really good sign when investing in a company. And they're the smallest company of the bunch at 22 billion market cap. So let me know what you think of the video. Do you have any other companies you want me to look at? Thanks for watching.